Hello world, my name's Jay Lopez and you're watching The Skeptical Investor. It is week 4 of our Dividend Battles experiment where we pin 5 different dividend investment strategies against one another and we document which one performs better over time. Before we go into today's topic, I did have some awesome news for you all, and you probably may already be able to tell what it is by looking at the stuff on the desk and also what I'm wearing. That's right friends, we've got merch now. And every single week, we will be doing a free merch giveaway on every single one of our videos. Also, over the next few weeks, we'll be working on setting up an online store, and I'll be sure to let you know when it's finally up and running. In case you're wondering, all the proceeds of merch sales will go directly back towards the channel to create and invest into more investing experiments and case studies that we have planned for you guys. This video will feature the very first giveaway where we're going to be giving away one of these hats and the shirt that I'm wearing. So be sure to watch the whole thing for instructions on how you can be a part of the giveaway. Now today, I wanted to introduce myself a bit so you guys know who I am. Also, I want to talk a little bit about risk. And last but not least, I want to talk about where the heck I get these $1,000 from to invest every single month into this portfolio experiment. So let's go ahead and get started. First in order, a little bit about me. I am 33 years old and I am the CEO and founder of a very successful and highly reputable company in the San Francisco Bay Area. I've been married for almost 6 years now, but prior to being married, I was totally living the bachelor life, a very minimalistic lifestyle with not that many responsibilities, and I spent most of my time volunteering for different nonprofit organizations and also traveling as a motivational speaker. In a matter of just 3 short years, we went from being nobody to growing the company exponentially, which leads me to the very first point I want to drive home in this video, which is you should always invest in yourself first. Now, what do I mean by that? Well, it depends. This is directly connected to who you are as a person. Only you know what your interests are, what you're good at, what you enjoy doing, etc. So how you invest in yourself depends on your level of self-awareness. For me, investing in myself meant spending a couple $100,000 into the latest equipment and technology so we could provide top-notch quality services and set ourselves apart from our competition. We also spent a lot of money in marketing and advertising so we could scale the business very rapidly. I did this because I knew that I wanted to be my own boss. I wanted to take full control over my destiny and finances, and also because I knew I could easily earn 6 figures doing this for a living. My company has now made millions of dollars over the last few years, but there's always a but, isn't there? I live in the San Francisco Bay Area, which is a very expensive place to live and operate a business out of. So a couple years ago, I began to research different ways to invest money because I wanted to develop a 5 to 7 year passive income plan, which would help me generate enough passive income so I wouldn't have to worry about my basic monthly expenses. Which leads me to the second point of this week's video, which is you should never invest more money than you can afford to lose. Because of this reason, I'm only investing into the stock market my passive income. So where do I get the $1,000 from, you might be asking yourself? Well, for years, I've been completely obsessed with real estate. So a little over a year ago, I made a killer investment into a 6-bedroom house, and the income I generate from those monthly rents is enough to cover the mortgage payment, which basically means I'm getting a house for free, and it leaves me about $1,300 of free cash flow every single month. By the way, if you would like to hear about the crazy strategy I used for the purchase of this home, go ahead and comment you'd like to hear more about that in the comment section below, and I'll be sure to create a video about it. Now, I know you've probably heard this before, but I should warn you, you should never, under any circumstances, risk your family's livelihood or use money that was meant for bills to invest into the stock market. Why? Because with any type of investments, there are risks associated with them. The beauty about risk, though, is that it can be easily mitigated, monitored, and managed. You just have to know what your risk tolerance is when making an investment. Now, I will tell you that although I 100% agree with that statement of never invest money that you can't afford to lose, by the same token, I like to take things to a higher level of thinking, and I would like to submit to you that you can't afford to lose the money you could potentially make should you have invested. And that's actually the whole purpose of this channel. See, when I was doing research into different types of investments, I ran into a huge amount of noise and advice that often contradicted each other. And rarely did I ever encounter people who would actually disclose their portfolios and real life results. So this was extremely frustrating for me. I heard people that claimed real estate was the best investment out there, others who said the stock market was the way to grow wealth easily, and then within the stock market proponents, some said dividend stocks were best, others said that tech and growth stocks were their preferred choice, other people preferred a more passive and hands-off approach and they invested into funds or ETFs, dividend stocks, small caps, mid caps, large caps, bottle caps. No, not really. Some day traded, others swing traded, some were long-term investors, and the list goes on and on and on and on. So in an effort to truly find out which strategies perform better, and at the same time drive my accountant completely crazy, I've decided to document my journey in experimenting with all kinds of different investment vehicles. My hope is that through these experiments, you'll be able to just sit back and get a front row seat to be able to see how some of these investments will perform so you don't have to necessarily risk your own money at first. Let's face it, investing can be a bit scary and overwhelming at times. So watch me risk my own money first so you can then make a more informed and educated decision. And this leads me to the third and final point this week, which is risk. See, risk is kind of like a four-letter word in the investing community. Actually, it is in fact a four-letter word. Anyway, you probably know what I mean. At times, we try and pretend the risk doesn't exist. We don't like to talk about it. We don't like to acknowledge it. We pretend it's not there. But when it starts to get close to us, we tend to be reactionary and run away from it. Basically, risk is like the middle child in your family. But next time you begin to weigh in your risk in an investment, I want you to think of these 3 quick steps before you take any action. And they all start with the letter M, by the way, so hopefully that will help you to remember them easily. Step numero uno. How can you mitigate risk in this investment? Risk mitigation is a strategy to prepare for and lessen the effects of a potential loss. Rather than planning to avoid the risk or completely ignore its existence, mitigation deals with the aftermath of a disaster and the steps that can be taken prior to the event occurring to reduce adverse and potentially long-term effects. In other words, before you make an investment, you'd want to ask yourself this question: what's the worst possible scenario or outcome with me buying this stock? And once you pinpoint that, then you begin to work backwards to set up an action plan to make your landing a bit smoother. For example, let's say you're interested in buying a $100 stock that you know is a bit risky but could potentially have a great upside. You do some research into the company and you begin to play a few different scenarios in your head, and you realize that there's a 50-50% chance the stock could go down to $0 or it could climb up to $1,000. This is how you begin to assess and plan your risk tolerance. In the stock market, a great way to mitigate risk is to set up a trailing stop loss. This will ensure to take advantage of any potential upside and appreciation while also covering your behind in case the stock begins to lose its value. You can easily set up a trailing stop loss in your exchange or brokerage. The opposite is also true. You'd want to find out what is your risk tolerance when the investment is going up and actually have an exit strategy in place that you'd want to stick to so greed doesn't get in the way of you making some profits. Too many people don't have an exit strategy on the way down or on the way up, and failure to have this in place will cause you to emotionally react to market fluctuations. So in our example, after you evaluate all the possibilities, you would commit to not selling the $100 stock unless it goes to, say, below $50. Now, it's important to have this $50 number in place because if this stock begins to drop its value like crazy, but say it only goes down to $51, you will not make an emotional reaction and end up selling the stock because it never really went past your previously determined and acceptable loss. This will make you a better and more disciplined investor and will take emotion or involuntary reaction out of the equation when you trade or invest. Step numero dos. How can you monitor risk in this investment? Once you have an action plan set in place to mitigate risk, you have to have a monitoring plan in place to follow up on the investment so you can eventually enforce your mitigation plan. There are lots of ways for you to check on your investments, but I personally don't like to obsess around my stocks and check on them all the time. I simply don't have the time to do so. So you may want to look into automated ways to monitor your investments. You can actually set up price alerts for any stock on any exchange, and you will get notified real time when the stock hits your target price. You just set the alert once and then you go on with your life. I like this approach because it takes away from you having to constantly check the progress of your investment, and it saves you a ton of time you would have otherwise wasted checking your brokerage account or app. And don't forget, your most valuable asset is your time. So anything you can do to waste less of it is an automatic and positive return on your investment. I know probably a lot of people right now are constantly checking their accounts to see how they're being affected by the uncertainty of the coronavirus. But with those alerts in place, you wouldn't need to stress about it one bit, unless you get the alert, of course. Just kidding. You wouldn't freak out. You would have listened to me and you would have already had a plan in place. Step number 3, how can you manage risk in this investment? This step should be easy by now. Now that you have mitigated and monitored your risk, all you have to do is simply stick to your guns and follow your plan of action. Because after all, what good is a plan if you don't follow through with it? I can't stress enough how effective and good trailing stop losses are. So if you would like to learn more about them, be sure to mention that in the comment section below, and I'll create a detailed video on them in the near future. Also, if you like these steps, be sure to give this video a like. You have no idea how long it took me to find 3 words that started with the letter M that accurately conveyed the concepts behind these steps. Let's see, what words do I know that start with the letter M? Mom, mammal, marsupial, no, that doesn't work. Motherboard, Now, let's do a quick recap of the portfolio and see where it's at. All right, so I signed into the M1 Finance account. Now, you guys might remember, but I did mention that this week, since it's the very first week of the month, I went ahead and invested another $1,000 into this experiment. And I just wanted to briefly show you guys which stocks I decided to invest the $200 into for each of these different portfolios. Let's start with high growth stocks. So for the high growth stock portfolio, I decided to invest the $200 into Disney. Now, the reason why I decided to do that is because I really like the Disney valuation at the time when I submitted the order. I personally like Disney a whole lot as a brand, and I do see a lot of potential with their Disney Plus service. It's actually been doing really, really well. Their subscriber base is growing like crazy. So it's a stock that I really believe has a lot of potential for growth. And so that's why I decided to invest the $200 into that particular stock. The valuation had gone down, so I just thought it would be a good time and a good entry to put the $200 into that particular stock. You can see that out of all the stocks that are in this portfolio, Disney is one of the few that is down. So I just thought that it would be a good time to grab this stock at a bit of a discount. For REITs, I decided to invest the $200 into Crown Castle International. I did tell you guys last week the reason why I like Crown Castle, so I'm not going to go over it. So that's why I decided to invest the $200 into it. And as you guys can see, it looks like we are up, which is pretty cool. Now, the Aristocrats ETF, obviously is an ETF comprised of quite a few different stocks in it. And I went ahead and obviously invested the $200 into that one. The SPDR portfolio, the SPYD, is the same story. It's comprised of a lot of different stocks. This one in particular has high dividend stocks in it, and that's why we went ahead and submitted $200 directly into this ETF. And now for the high yield stock, I decided to invest the $200 into Carnival Corporation. Now, Carnival is a cruise ship company, and I just really, really like the valuation of the stock. At the time of this recording, news started to report that there's actually a few cases of coronavirus inside of some of these cruise ships. So the price just went down, and I just thought of that as a great opportunity to buy the stock at a pretty good discount. So I really like the price of it, and I just couldn't pass up on it. So that's why I invested the $200 into this stock, and we were able to get, about 4 shares for that price. Now, the one thing that I did want to point out is the fact that REITs are still at the very top so far. Now, this is probably attributed to the virus again, because housing just simply won't be affected by news of a virus that is going around, right? I mean, there's no way real estate will be affected by something like that. So it makes sense that REITs are at the very top right now. High growth stocks, though, are still on number 2. So far, it seems like if you pick certain winning stocks individually, you're just going to perform better over time rather than investing into a much safer ETF. And the high yield stocks are doing pretty bad, which again, this is kind of like a bit expected because some of these stocks could be a yield trap. Man, IBM is doing really, really well. They've had some awesome news lately, and it's just too bad that we have such a small position in it. It's up 12.86%, and I think this is the one stock that has gone up in price the most out of all the stocks that we have in all these different portfolios. But then again, with these high yield stocks, you just never know what's going to happen with these companies, so it's hard to be able to tell how they're going to perform over time. But anyway, that's it as far as a portfolio update. Again, I can't wait till we actually begin to get some of these dividends from these companies, because that's just going to make this a lot more exciting to be able to see some of that passive income coming in and be able to reinvest the dividends into some of these companies. Anyway, that's all the time I have left for now. Thanks for sticking around to the very end of this video. If you would like a chance to win one of these hats and the same shirt I'm wearing, armpit stains and all you gotta do is give the video a thumbs up, post a comment or question below, and share this video in the social media platform of your choice. Also, be sure to subscribe to the channel and hit the notification bell, because I will be announcing the winner of this week's video in next week's video. So you don't want to miss next week's video. As always, thank you so much for spending a little bit of your time with me. Stay invested and be blessed. See you next week.